Okay, I think we'll get things underway, just mindful of time and people's diaries. So, good afternoon, everybody. A warm welcome to this new to partnership webinar being run by the professional firms team at Moore Kingston Smith. Today's seminar is aimed at a combination of both new partners in professional firms and also those on the path to partnership. For those of you who don't know me, I'm John Staniforth, and I'm the head of professional firms at Moore Kingston Smith. And it's my pleasure today to chair today's webinar. I'm going to start off by introducing our wonderful panel of speakers. So first up, we've got Tim Stovold. Tim is the head of tax at Moore Kingston Smith. Tim, like myself, trained at Moore Kingston Smith and was promoted to being a partner in our firm in 2006. So he's approaching 20 years as a partner. Tim has been advising professional firms on a variety of tax issues over that period, drawing on his experience on employee taxation matters and also advising on emerging issues specific to the sector, such as basis period reform and unfortunately HMRC's changing view on their interpretation of salaried member rules. Next up, I'm pleased to say we're joined by Johnny Cakebread. Johnny's a partner in the professional services group of the law firm Addleshaw Goddard. Johnny has developed a wide knowledge of the legal issues facing professional services firms and regularly advises clients in a number of sectors, including law firms, accountants, surveyors, and architects. Thirdly, we've got Matt Corgi. Matt is a financial planner and mortgage advisor at Moore Kingston Smith Financial Advisors. Matt has a broad knowledge base and offers a well-rounded approach that includes protection, later life and inheritance planning, tax planning, mortgage advice, and investment management for both individuals and business owners. And finally, we have Pooja Maini. Pooja is a director in our professional firms team at Moore Kingston Smith. Pooja is responsible for leading both compliance and advisory work for a varied portfolio of clients, including several mid-tier and large law firms. Very shortly, our guest speakers will explain how life has changed now that you're a partner from each of their specialist perspectives. When all four speakers have finished, we will open up to questions. So please do post any questions that come to mind in the Q&A function as we progress. So turning first to Tim. Tim is going to provide an overview on the main differences in your personal tax status now that you've become a partner in a professional firm. Over to you, Tim.
Thanks, John. And the best news, if I'm approaching 20 years as a partner, I think I might get an extra day's holiday, which is good news. So
You might.
that's a helpful reminder. Right, so we're going to start on tax. Thank you, John. So the first thing, if you're employed in your professional firm at the moment and you're being promoted up to partnership, the first thing you're going to get is a P45, which is normally a bad thing or interpreted as a bad thing. But this is merely the shift from being a paid employee on the payroll to being self-employed. Unless you're a salaried member, we're not going to deep dive too much into the salaried member rules because most professional firms will work quite hard to avoid their partners being salaried members. So everything that follows is on the assumption that you become a self-employed partner in the business. You've got your P45 and you're now self-employed. As a partner, you're taxed on your profit share. Your profit share is not necessarily the same as your drawing. So the profit share is calculated for the year to the 5th of April, or if you've got a 31st of March year end, it's the 5 days are more or less ignored. If you haven't got a 31st of March year end, if you're in, say, a December year end partnership, then in order to calculate your profits, we stitch together 9 months from one year and 3 months from another. But most professional firms are now moving to a 31st March year end to make life simpler. As I said, drawings are not necessarily what you're going to be taxed on. Drawings is what you take out of the partnership each month. Your profit share would generally be a higher number. There'll be deductions from your profit share towards your tax liability. There may be other withholdings to keep some working capital in the business. So gone are the days where you receive a pay slip and what you're taxed on is what you're paid on your pay slip. What you take out is your drawings. What you're taxed on is your profit share. If you're not already filing tax returns, you're going to need to file personal tax returns. Generally, if you haven't already registered for self-assessment, you register by the 5th of October following the end of the tax year in which you become a partner. So if you became a partner in the current tax year, the year ended 5th of April 2026, you would need to register for self-assessment by the 5th of October 2026. If you don't, strictly you get charged a penalty, although we rarely see it charged, but it's good practice to do everything by the due dates. The tax return is due by the following 31st of January, so the tax return for the year ended 5th of April 2026 is due to be submitted by 31st January 2027. And that's when if it's your first year as a partner, that's when your first tax payment's due. And you're also going to have to pay a 50% payment on account for the following year as well. And I'll just go through that as an example. A further 50% payment on accounts due in July, but probably best explained with an example. Let me just move that over to that side of the screen. So what I've done is I've said, look, for the current tax year 25-26, if your first year tax liability is £50,000, and in the following year your tax liability is £60,000, this is how your tax payments are going to fall. So on 31st of January 2027, that's the due date for submission of your return and the tax payment, you would pay £50,000 tax liability for the 25-26 year. You'd also, in the next column along, pay half as much again. So the payment on account is set by the figures HMRC know. It's set as being 50% of your liability for the current year. So in that year, you'd be paying £75,000 worth of tax, even though your liability was only 50,000, because you're paying this 50% on top. You pay another 50% in July 2027. And then when you come to the filing date for the following year's tax return, 31st of January 2028, your payments on account are compared to your liability for that year. So in my example, your liability is 60,000. You've paid two lots of 25,000, so you've paid 50,000 already. So you've got another 10,000 to pay. And then you're back into payments on account. So you'll pay another 50% of your current year liability, 50% of 60,000 is then 30,000 paid on account, and then the same in July, and then the roundabout spins again, and you go on to your following January. What's clear, and I think what partners need to plan for, is that first year's tax payment, your first year as a self-employed person, that first payment on account it means that your first tax payment is large. Now, normally, what will happen is, I can just get on to the next slide, it's only two. What will normally happen is the partnership will reserve for your tax liabilities. So it's not that you've got to go off and remortgage the house to fund this tax. Normally, partnerships will reserve that tax liability against your profit share, and that will be dealt with through the partnership. But this is something to confirm. As soon as you go into partnership, you ought to be really looking at some sort of tax estimate of what liability is going to fall due and when, and making sure there's enough money either withheld from your profit share, or you've got other arrangements to pay those taxes when they fall due. Bear in mind that the difference between being an employee and being a self-employed partner in a partnership is, as an employee, the PAYE deduction, the tax deduction source, is generally pretty accurate. It's the tax deduction based on what you're paid in the month. The tax reserve, which is dealt with by the partnership, is done to varying degrees of accuracy. Some partnerships will do an accurate calculation, taking all the tax rates, maybe taking into consideration things like pension contributions and maybe even student loan repayments. Others will just apply a flat percentage to your profit share, and that's the basis on which they're reserved. So it's worth, again, checking with the partnership, doing some sort of forecasting with tax advisor to make sure the tax reserve is going to cover your tax liability when it falls due. Your tax return is not just to include your partnership income. When you're in the tax return system, you may already be in it for these reasons. You should be declaring your bank interest, your rental income, any other income you've got. So it's a complete description of your income. If you're in the unfortunate position of having to repay student loans, and that's of course a focus in the press at the moment with all the changes going on, the student loan repayments, which were previously dealt with through your payslip, are now dealt with on your tax return. So if that isn't dealt with in the tax reserving by the partnership, that's an extra liability that's going to fall due at the end of the year. You need to be putting money aside from that because it's no longer taken at source. The tax return, it sounds a lot like bad news, but there is some good news on there. You can look for anything you've got that's tax deductible. So if you're making personal pension contributions, no longer is that going through your pay slip. That's going to be paid from you personally. So you need to claim tax relief on your pension. Often missed, as you sponsor friends running the London Marathon or anything else, anything you're doing under gift aid, any charitable donations, you'd also claim on your tax return. That can reduce your tax liability. And partnership capital loans I'll come on to in a second, but you generally would have a partnership capital loan where you've borrowed money to invest in the partnership. You'll be paying interest on those loans, and that interest is also tax deductible. So one of the things your tax advisor will do, whether that's done in the partnership or by external advisors, is look for as many deductions as we can find to bring down your liability. Be wary about other business expenses. So if you happen to buy, I don't know, a journal, a legal journal, or something yourself, which you consider a business expense, you can only claim that against your partnership profits if that expense goes through the partnership. If you've just claimed it personally, it's very difficult to get that deducted against your income. So bear in mind, if you have got expenses, it's better they go through the partnership rather than you incur them personally to get the tax relief. I mentioned I've thrown a few phrases in, as did John, salaried member rules. Salaried member rules are a set of tax anti-avoidance rules which can cause a self-employed partner to be treated like an employee for tax purposes. One of the ways in which we can avoid being caught by those rules, although it shouldn't be done only for this purpose, is that a partnership capital loan is put in. You invest capital into the partnership. You generally are putting in at least 25% of your profit share. And that's generally funded with a bank loan. The bank loan organised by the partnership, and there'll be interest payable on that, generally paid by the partnership directly. When your tax return's completed, that interest paid should be identified so it can be claimed as an expense against your income. An awful lot of content on 2 slides. I'm going to pause there to give my fellow panel a chance to speak as well. So, John, I'm going to hand back to you.
Thank you, Tim. As I said, we'll deal with questions at the end. So next up is Johnny Cakebread. So Johnny's going to explain what your legal rights and responsibilities are now that you're a member of an LLP. So over to you, Johnny.
Thanks, John. Hopefully you can all see my 1 slide compared to Tim's 2. But as John said, I'm briefly just going to look at the legal implications of moving from being an employee to a self-employed LLP member. And that's mainly focusing on the differences between the legal rights and obligations you have as a partner compared to being an employee. So the first thing to ask is actually, where do you find your rights and duties as a member? And I'm sure that most will be aware that the key document to look at is the LLP Members Agreement, which effectively replaces your employment contract as the principal place for your contractual rights and obligations. Certainly worth asking for one if you haven't been just directly provided it. I'm fully aware that lots of people, just sign up the dotted line with the prospect of partnership without necessarily reading too much detail about the LLP agreement and being fully aware that they won't be able to actually renegotiate its terms anyway. But I just wanted to flag a few points that, in terms of the financials in an LLP agreement, that is key to look at, which Tim's briefly touched on some of them as well. So obviously your remuneration moves from being a salary to a profit share, which means that from a legal perspective, it's on account of profits that are generated by the firm. And that means at the end of the year, the business actually needs to have made the profits in order to meet your distributions. So if you effectively distributed more profits during the course of a year than there is profits at the end of the year, you might have to pay something back. And that's why most firms adopt a conservative drawings policy, so that monthly drawings equate to something like 50% of your anticipated profit share, and then you get effectively residual profit share distributions after the financial year end. And that one area to focus on as a new partner is whether actually your monthly salary payments will be, your monthly drawings payments will be less than you received as a salary as a result of that distinction. Also, just a quick list of other financial sort of hygiene points to look at in your LLP agreements is whether as a junior partner your entitlements effectively rank in priority to a senior partner. So that if there's any profits available, they go to a junior partner class first. Does the firm have the ability to actually change the amount of drawings they give you during the course of the year, which obviously does have a material impact on financial planning for partners? Could you be required to put in more capital without your consent? As Tim mentioned, most firms do require capital contributions to be made, and that effectively is a partner's risk in the business, much like a shareholder's capital in a limited company. And also, as Tim mentioned, just need to be wary about how your tax whether the firm reserves for tax out of your profit share or whether they pay you gross and require you to make your own arrangements. Another document that's becoming increasingly common for partnerships is a sort of partner's handbook, which is akin to an employee handbook, which just sets out sort of specific benefits and policies that apply to particular areas of a partner's life. And normally that's just all the good stuff that you see in an employee handbook. I thought I'd just briefly mention employment law as well. much in the same way for tax purposes, you're likely not to be an employee. If you're a member of an LLP, you can't at law also be an employee. So employment law does not apply to you. But there are certain worker rights, which I'll get onto, which do. And that is one of the main concerns of new partners, is effectively, are you losing all your employment rights? And because of that worker status point, is actually not as significant as you might imagine, as I'll come on to explain. And lastly, just there are various rights and duties under statute, but I just thought I'd flag the Insolvency Act. Because, as I said, in the unlikely event of a firm going bust, your capital is at risk. But also, if the LLP continues to trade past the point of no return, there are specific provisions that require partners to pay back amounts that have been distributed to them. So in terms of the legal duties of an employee against a member, contractually, as I said, you'll be looking at the LLP agreement rather than the employment contract. In terms of sort of general duties owed to an employer compared to an LLP, employees owe effectively a duty of good faith to their employer, whereas members have a slightly more onerous obligation in that in their fiduciary position, they have a requirement to act in the best interests of the LLP, as opposed to just having regard to the interests of an employer, which is a subtle but quite important distinction. Also, the other way around, what general duties does the employer or the LLP owe you as a member? The answer is actually nothing. So an employer owes a duty of trust and confidence to an employee, but there's no equivalent right for members of an LLP. Then moving around clockwise, legal rights for employees against partnership. Again, because of that worker distinction, there's actually certain rights that will apply to you as a member, one of them being whistleblower rights, which are protected by worker status. Equally, the Equality Act requires that you cannot be discriminated against as a member in the same manner as an employee. So all those protected characteristics apply in your position as a member as well. However, there are some significant differences. So, for example, family rights, all the parental leave statutory provisions don't apply to you as a partner, albeit most firms will contractually agree in either their LLP agreement or their handbook to apply a form of parental leave to you as a partner. Similarly, on exit, the employee rights of unfair dismissal and redundancy payments don't apply to a member. So you'll be looking at the LLP agreement to understand how you might exit the business. And that leads me neatly on to the last subject, which is termination, which hopefully won't happen for a long time for a lot of you, given the audience in this webinar, but effectively there is a difference in that there is no statutory minimum notice period for a partner compared to an employee. Normally, the notice period will be set out in the LLP agreement, and as a sort of general rule of thumb, it will be longer than an employee. You'll also need to consider whether there's what we call a waiting room provision, restricts the number of individuals that can resign in a given year to prevent sort of capital outflows, but can also mean that partners are effectively kept in the business for a longer period. And then also considering whether you can be forced to leave the partnership for what we call no-fault retirement. And indeed, what's the notice period in respect of that no-fault retirement? Equally, you should have a look at whether the LLP agreement has some covenants in them. As a general rule of thumb, LLP members are subject to more onerous covenants than employees for various reasons. And then when you actually leave, you should look at when you actually get paid the final year's profit share in your capital, which can be a significant lag time to actually the date that you cease to be a member. And the last point is increasingly commonly seeing sort of bad leaver type provisions come into LLP agreements, so that there's some extra financial consequences in the case of misconduct. So that was a very whistle-stop tour, but I will pass over back to the MKS team.
Thank you very much, Johnny. Good. So next, over to Matt Corgi. Matt's going to take us through what your financial planning options are following your change in status from being an employee to now being a member of an LLP.
Lovely. Thanks, John. Unlike Tim and Johnny, I don't have any slides, so I'll jump straight in as well. Firstly, mortgages. Now, once you're no longer receiving payslips, lenders will need a very different proof of income. Typically, most lenders will need 2 years' worth of tax computations. So these are produced after submitting your self-assessment each January. In theory, then, it means that it could take up to 3 years until we have sufficient evidence to give to a lender to support a mortgage application. There are some lenders that will accept 1 year's tax computation, but the rates are so much higher, it's typically worth avoiding if possible. So, what should you be doing if you know you're moving to partnership or you're on the journey to do so? If your mortgage ends ideally within 2 years of that happening, you should try and consider moving to a new fixed rate product before leaving PAYE or getting your P45 and locking that in for ideally 3 or 5 years, depending on how long it's going to take you to get those self-assessment tax computations. Lenders will need an average of 3 months payslips. They can ask for 6. So it's well worth starting the process way in advance, just so you've got enough time. There are some lenders that will accept an employer's or the partnership's confirmation or an accountant's certificate confirming what the projected income is going to be, but you're far more reliant on the underwriter's discretion at that point, and the risk is that they simply say no. Now, just to say, typically, you can rate switch with an existing lender. So that means that you do not change the structure of an existing deal. It just means you can't change the actual terms, i.e. how much you're borrowing, moving to a new property, or the actual term of the mortgage itself. The sort of final point is, even if you're not looking at partnership for a couple of years, when your mortgage comes up, start the process again 6 months before and lock in the rate as soon as you can. If rates go against you, it doesn't matter, you've locked in that rate. Whereas if rates continue to come down, which we're forecasting that hopefully they will continue to this year, you can actually just keep updating your offer until typically 3 weeks you need to complete. So key changes, Tim mentioned earlier that depending on the partnership, they'll either ring fence some of the monies that you need to pay your tax bill every year, or you will need to take ownership of that. If the latter, there are a couple of ways that you may look to do that. One option is an offset mortgage, which we find quite a lot of people find useful. So this could be, for example, you have a £500,000 mortgage, you put £100,000 in the offset account, you're only then going to be charged interest on £400,000 of your mortgage. That money in the 100,000 in the offset facility is entirely liquid. So when the 31st of January rolls around and or July, you can then take the money out of the offset account and simply pay the tax bill. Now, you're not earning money on this, you're saving interest, so it's very tax efficient. The alternative option could be gilts. Again, we see some clients using what we call a gilt ladder. So they'll ring fence the money in low coupon gilts, with the growth being tax free, and every year that's then available for them to use to service the tax. Protection. So when you're employed, you typically will have the 4 main type of benefits. Death in service, it's usually about 4 times your salary. Income protection, so this is designed to replace your income if you can't work due to long-term illness. And critical illness cover. So think of that almost like death in service, but it's if you develop a critical illness, it will pay a lump sum out, typically used to pay off the mortgage. And then finally, private medical insurance. So just expediting and getting slightly higher quality care if needed. So when you're self-employed, partnership, these usually drop off overnight. There are options and instances where you can actually continue the workplace policies, so it's worth seeing if that's the case before you transition over. In the instance you can't, ideally, you won't have just one type of protection, but a suite, because then it's going to cover lots of different scenarios. In order of priority, we typically see it's income protection first, so it's replacing that regular income if you're not able to work due to that long-term illness. We ideally will align that with your retirement age, whether that's 45, 55, or retirement age with state pension at 68. The other types, again, are life cover and critical illness. So this is really important if you have dependents and or in the event you can't work, you want the ability to just clear off that mortgage in full. And then finally, again, private medical insurance. So number 4, pensions. Tim mentioned earlier, but once you are moving from employed to partnership, you're no longer going to have the auto-enrollment new pension set up. So this then becomes your responsibility. Now that actually also provides a couple of options for you and opportunities in that you may have legacy pensions sitting in the background. So whilst looking at the pension, you can almost pick everything up in one go. Ideally, number one, consolidating all of those historic pensions. Now, I will caveat, you'll need to check that there are no valuable benefits that would be lost upon consolidation. So some schemes, for example, will have a guaranteed minimum retirement age. So retirement age is increasing from 55 to 57. Some schemes will say, no, you can still retire at 55. So actually, it may be worthwhile ring-fencing that pension and either consolidating backwards to that scheme, or if the plans are that you don't need to retire at 55, then you can move on. The other would be changing the underlying investment. Now, typically with your old workplace schemes, they'll be invested in the least offensive fund to the most amount of people and not necessarily aligned with your own retirement plans. You'll probably also have an element of what we call lifestyling, which in effect just de-risks the pension at a preset age. But actually, you might be planning to work past that age, or you don't want to buy an annuity and you want to keep the money invested and growing in the pension whilst you top up your income. So again, whilst you're consolidating and setting up a new scheme, it might be worthwhile just changing the underlying investment itself. So the final point is contributions, setting up regular contributions. So how much can you put in? Every year, currently, you can put in a max of £60,000 a year. That's called your annual allowance. Now, be aware there are tapering rules. So that allowance actually reduces when your income starts to exceed 260,000. So you begin to lose £1 of that £60,000 annual allowance for every £2 over 260,000 you earn. We usually see this in the early years. That's the opportunity to almost front load pension contributions. Frustratingly, it's also when you typically got high mortgages, family, school costs, etc. So there's a bit of negotiation around how much do we actually put in. Just for reference, your annual allowance would be tapered to a minimum currently of £10,000 a year. That's the max you can put in once earnings exceed 360,000. Appreciating you can't always just front load everything in one go, what we often will look at doing is utilizing the current year's annual allowance as much as we can. And if possible, you can actually go back for the last 3 tax years if you have unused allowances. The earliest year currently is going to be 40,000. As soon as we move to the 6th of April to the next tax year, you actually lose the earliest year and it sort of moves forward like a conveyor. So the ideal scenario would be that you max the current £60,000 and the earliest years. Once we get past the 6th of April, it doesn't matter. You've not lost any of the allowances and you've got time to still backdate the others. So final points of guidance from me. Don't wait for perfect timing. I'd probably suggest, if possible, set up regular pension contributions. You're also going to benefit from pound cost averaging. I mean, we have lots of conversations at the minute around an AI bubble. So yeah, it's probably better to drip feed in. I didn't really mention why pensions, but it's purely because of the tax efficiency. So again, Tim sort of alluded to this earlier. £80 invested is actually £100 invested after tax relief. Plus, if you're a higher or an additional rate taxpayer, you can then claim back that additional tax relief. So it's very, very well worth doing. The other benefit is it's like an ISA. All the compound growth within that wrapper is tax-free. It's only when you draw the money out in later life that there are tax implications, but that's the huge benefit, is that you've got that long-term compound growth ability. And then the final thing I'll say is the self-employment route gives you the flexibility, but no default safety net. So it very much is your ownership at that point to manage that yourself.
Thank you very much, Matt. And then last but not least, we've got Pooja, who's going to describe some key performance indicators, so key KPIs for short, that you may well hear in passing in respect of your firm's annual accounts or even the firm's management information. So Pooja's going to do her best to kind of take accounting terminology and put it into plain English for us all.
Thanks, John. So over the next few minutes, I'll just sort of give a pretty straightforward overview of how LLP accounts work from a general practice perspective. And I'll focus on terminology that you'll see in your firm's annual accounts, as John says, and then management information, focusing on sort of concepts that are specific to LLPs. So as new partners, having a basic understanding of all of this will obviously help you interpret the numbers that ultimately drive your remuneration. I'll start with talking a bit about KPIs that you'll likely see when management information is shared with you and what each of these kind of mean. So lots of benchmarking reports relevant to professional firms naturally talk about revenue growth and revenue per partner, which is obviously very important. But as new partners, in reality, you'll sort of be more interested in the profit metrics, as profit forms the basis of your remuneration. So just starting on operating profit. Operating profit reflects the profitability of the core business itself, so before non-operating items go through, so before things like interest or exceptional items go through. And it is a key measure of underlying performance of the LLP. And often this is a metric that does link directly to partner reward models. The next one is profit before members' remuneration charged as an expense. I mean, this is particularly important to new partners because it's the number that's shown on the face of the balance sheet, and it represents the kind of profit pool available for allocation to partners. So it's likely the most meaningful benchmark for you when you're assessing year-on-year performance. The next one is lockup. You'll probably hear the term lockup quite a bit, and essentially this means this measures the firm's working capital efficiency. So how long it takes the firm to convert work completed into cash. So lockup is essentially based on the level of work in progress and the level of fee debtors. So in simple terms, lower lockup means healthier cash flow, which will depend on timely billing and effective debt collection. And high lockup, on the flip side, increases cash flow pressures for the firm. So just touching on drawings and tax reserves, obviously we've heard a bit about tax reserves already, but as partners, you obviously, as Tim says, you're not on PAYE. So the drawings that you will see are going to be cash distributions, and that's not necessarily going to equate to your full profit allocation. Working capital requirements of the firm will dictate how much is retained within the LLP. And even if your firm sort of operates a full distribution model, as we've already spoke about earlier, most firms will retain a tax reserve from your profit share to fund your personal tax liabilities. So just moving on to items that are specific then to LLP financial statements. One of the biggest differences that newly promoted partners notice within the accounts is how members' remuneration is presented. So LLPs don't operate like companies when it comes to partner pay, and member pay basically falls into sort of two categories in terms of how it's presented. So the first is members' remuneration charged as an expense. So I've got a slide up that sort of highlights where that's shown on the face of the profit and loss account. But essentially, this is profit that the LLP is contractually obliged to distribute. So in other words, at the balance sheet date, the LLP has no discretion over how these profits are allocated. It's shown as an expense, as you can see, in the profit and loss account, and essentially what it does is reduce total profit. And the amounts that are to be treated in this way are typically agreed in advance and would typically be set out in the LLP or partnership agreement. So, for example, fixed profit shares or profits that are sort of calculated based on predetermined formulas. The second is profits available for discretionary division. So this is essentially the residual profit left after expenses are deducted. So there's no, in this case, there's no binding obligation for the LLP to distribute this profit at the reporting date. And essentially the LLP can have pure discretion behind how it's allocated to partners or whether it's just retained in the business. In practice, we typically see firms treat all or majority of partners' remuneration as members' remuneration charged as an expense. But you know, there are some firms that don't. ultimately, the distinction is not about whether profit is fixed or variable. It's about whether the LLP has an unavoidable obligation at the year end to distribute LLP profits. I'll just briefly touch on capital. It's another important area in LLP accounts, i.e. how members' capital is classified, and it could be classified as debt or equity. So, whilst all members' capital is presented in the bottom half of the balance sheet, there is a difference between whether it's classified as equity or debt in the members' interest note. So again, the principle is very similar to the treatment of profits. Does the LLP have an unavoidable obligation to repay the capital? And if capital must be repaid automatically, so for example, on retirement, capital is repaid to the partner, it would be classified as liability, i.e. debt. Basically, it behaves in a similar way to a loan. And if on the flip side, repayment is discretionary or conditional, then it would be treated as equity. So finally, I just wanted to briefly talk you through sort of specific disclosures that you may see in LLP accounts. Just so you're aware, LLP accounts, so for mid-tier firms, also contain certain disclosures that you wouldn't see in a company set of accounts. The main ones I wanted to highlight were the highest paid member disclosure, which is mandatory and often is the one that attracts quite a bit of attention. The average number of members is disclosed, and also details of profit allocation policies and sort of how profits are divided is also disclosed. Essentially, all the disclosures are designed to provide transparency around how the partnership is structured and governed. So hopefully this kind of gives you a bit of an overview from a general practice perspective, and I'll leave it there so that we have enough time to open the floor to questions.
Thank you, Pooja. Okay, so we'll now move on to the questions that we've had posted in the Q&A function. I did spot actually that as we were going through, Tim did actually usefully actually answer a question directly whilst the webinar was progressing. So I'll just run through that for people. So the question that was posed was to clarify: the profit share is taxed in the year in which it is earned rather than when distributed. A firm's financial year usually extends over 2 tax years. So Tim explained that it is the actual profits now that are earned in the year end of 5th of April that are taxed each year, whether they're distributed or not. And if the firm's financial year is not coterminous with a tax year, so it's either not the 5th of April or more commonly the 31st of March, then the profits for the tax year need to be calculated by taking from 2 different accounting periods. So you kind of put 2 accounting periods together. So the example that Tim gave was that if the year end of the partnership is 31st December, the taxable profits will be made up of 9 months from one accounting period and then 3 months from the following period. And that all changed a couple of years ago with the introduction of basis period reform. We've got a few more questions, so we'll try and get through as many of those as possible before we're due to finish at 12:45. Probably a question for Johnny first of all. I can see there's one relevant to the legal side. So Johnny, are restrictive covenants in LLP agreements enforceable?
Well, that would take more than the 5 minutes we've got left to answer. But the short answer is, in our view, yes, they are. The rather interesting point is there's no actual decided case law around restrictive covenants in LLP agreements. So most advisors in the field are effectively making their best guess about what is enforceable and what's not. The general view, as I said in my presentation, is that covenants for LLP members sit somewhere in between employee covenants and the covenants you'd see in a business sales situation. So likely to be more onerous and enforceable than employee covenants, but not as onerous as covenants you'd see in a sale agreement. So a bit of a lawyer's answer, but that is the current state of play.
Right. Thank you, Johnny. Question for Pooja now. You talked about lockup as a kind of a key term that comes up all the time in professional firms. So what kind of practical measures can a partner in a professional firm do to try and improve their firm's lockup?
Yeah, that's a really good question. And as a partner, obviously, you are the ones that are sort of key to improving lockup. As I mentioned, it comes down to timely billing. So billing your WIP and collecting your debts from clients. So billing earlier and more regularly is important. Ultimately, WIP that hasn't been billed can't be collected. So don't avoid difficult billing conversations. And from sort of a fee collection stance, being clear with clients on payment expectations up front. So, they're expecting bills to be raised at the frequency that you're raising them. They're clear on payment terms. And, if you've started this narrative at the initial onboarding stage rather than kind of at the credit control stage, then you're obviously giving yourself a head start.
Thank you, Pooja. Next question actually probably could be answered by either Tim or Matt. So I'll probably be nice and ask whoever kind of answers first can answer the question. So I think obviously quite a lot said about how tapering can happen to annual allowances for pensions for partners in professional firms, because partners in professional firms tend to be on relatively high profit shares. So just could you give us a couple of kind of practical examples of how a particular partner's pension allowance might be tapered? So let's say I think Matt said that the figure is anything over 260,000. That's the point at which a person's annual allowance, starts to be tapered. So if we take a figure of 300,000, how would that calculation work in terms of the tapering?
I'm going to leave that to Matt as I turn my light back on. But yeah.
So yeah, in effect, 60,000 full annual allowance up to £260,000 of earnings. So as soon as you start to go, and again, you'll lose £1 of the annual allowance every £2 over that threshold you go. So at £300,000, you've got what? You're £40,000 over, you've lost £20,000 of the allowance. So your annual allowance would come down for that tax year from 60 to 40. So that's your new allowance there. Now, again, you can still use the carry forward allowances for the previous 3 tax years. So it just reduces that current year's allowance. But of course, you need enough income, call it relevant earnings, in order to make the pension contribution itself. We tend to find, as I say, the earnings are early doors a lot lower. So we've got that initial time frame to actually get the money front loaded into the pension. The real restriction depends on what sort of role you're doing, but 5 to 10 years in, when we completely lost that allowance and suddenly we've only got the 10,000, which is again the absolute minimum that you can put in. That's the lowest it's currently reduced to. Now that's the final thing I'll say on it, subject to legislative changes. The goalposts are constantly moving. I mean, we did have the money purchase annual allowance, and the previous allowances increased from 4,000 to 10,000. So it might come again with this tapering, but we don't know.
I'll just sort of add to that. I mean, the pension contribution has to be made in the tax year to use the allowance. But I know, having just got through a January from hell of filling out tax returns or reviewing tax returns, that we are often getting the partnership profit share figures very, very late in the day. So the tax year ended 9 months ago. We're filling out the tax return in January and screaming at the partnership saying, "Give us your numbers." Where we're not in control of them. In which case you don't know what your annual pension allowance is in the year that you're making your pension contribution. A full and open conversation with somebody in Matthew's profession, your financial planner, to make sure that you don't over contribute in your pension, because you'll find that you've got an income tax liability on over contributing. Maybe modest sums, but we've certainly seen 40, 50,000 pounds of income tax liability where people have made big pension contributions above where they're able to.
Just to add to that as well, we'll usually try and actually use some of the previous carry forward allowance to make sure that we've got a buffer so we don't have that tax charge.
It's just throwing that all into the pot and making sure you don't sleepwalk into a tax bill you could otherwise avoid.
Good. And we just got time for one quick question, just so that Tim's not left out completely. I know he kind of jointly answered the last question with Matt, but kind of a common scenario, Tim. You've got a partner that earns a certain profit share in year 2 of being a partner. In year 2, that they'd normally expect an increase in their profit share as they progress within the partnership. So from year 1 to year 2, their partnership profit share increases. Consequently, their all other things being equal, their annual tax liability increases. Is there a requirement on the partners to actually increase their payments on account to reflect that expected higher tax liability?
No, and the payment on account for any year is always set as being a maximum figure of 50% of the current year liability. So even if your profit share is increasing tenfold from one year to the next, your payment on account will only be based on the current year profits. There's no downside of not paying the additional until the very latest moment, till the 31st of January following the later tax year. There's also, I mean, John, we're always optimists that profit shares are going up. You may have a partnership that has a phenomenal year and the partner's absolutely rake it in that year, but no, it's not going to be the same the following year, in which case you can actually reduce the payment on account down if you anticipate your profits will be lower. If you've reduced it too far, you reduce it below your actual liability, there'll be some late payment interest, which is running at about 8% at the moment. So you reduce your payments on account with caution.
Great. Thanks very much, Tim. That's very clear. I think we'll wrap things up there, just mindful of time. So many thanks to all of you for tuning in to today's webinar. We hope that you found the content very useful. Please do get in touch with a member of our professional firms team if you have any follow-up questions after today's webinar, or if you feel you benefit from some more tailored advice to your own personal circumstances. And finally, a big thank you to all 4 of our guest speakers. So to Tim, Johnny, Matt, and Pooja, thank you very much for sharing your expert knowledge on your areas of expertise. Thank you very much. Goodbye.